It is a new year, and I purchased 2 dividend stocks this week. I purchased more shares of BP, the oil super major, huge starting dividend yield, and I purchased more shares of PPL Corporation, the regulated utility company, electric utility that has operations in the United States and the UK. I'm really excited because one of my primary goals in 2020 was driving immediate cash flow that I can use via dividend stocks to pay the bills. And so stocks like BP and PPL, which have high starting dividend yields, are right up my alley. Now, I want to take this opportunity in the video today to share my experience buying these stocks today and also some feedback from the community, because the feedback honestly was a little bit interesting, and it's through the comments, through the community, that I feel there are certain investors out there who want to approach dividend investing. They want to be dividend investors, but they're kind of looking at it a weird way. Quite frankly, I think there are investors out there that are making mistakes. And so I want to take the opportunity today, in today's video, start of a new year, to share the mistakes that I think investors are making when looking at dividend stocks. So I'm going to jump into it. This is going to be a really exciting video. Get ready, everyone. Dividend investing. All right, so before I can even address the mistake that investors are making, I need to do this through example. And so I'm going to share some stats on the screen right now as it pertains to my purchase that I made earlier this week in BP. So check it out. I purchased BP at $39.78, and it's already come down. The current price per share is $38.83. I'm already, quote unquote, down, on paper at least, by 2.4%. All right, the recent low was $36.94. And so my purchase price of $39.78 was about 7.7% higher than the recent low. So some investors could say I'm down already 2.4%. Other investors could say, Ian, you paid too much. You paid 7.7% higher than you had to if you had just bought at the recent low. And so the reason I'm pointing this stuff out, quite frankly, is I believe the mistake investors are making is they're scared to invest, or they're just getting too caught up on share prices and share price volatility. We will get more into this in a minute through mathematics to prove my point. But before that, I want to rationalize why it is that I bought BP at the price that I did. Check this out. The 2019 analyst consensus estimates for this year, or for last year, in terms of earnings per share, are $2.94. The 2020 analyst estimate is $3.26. And so the analysts believe that earnings per share will rise for this company year over year quite a bit here. It's actually doing well. That places the 2019 PE price earnings ratio at 13.53. and 2020 at 12.2. And so from a strict PE ratio metric, BP right now, even at the high price I paid at $39 and change, which is quote unquote higher than I should have paid, it is a value in my opinion. And I like it at the price that I bought it. I like it even more at the price that it's at right now. Let's look at some more statistics. The dividend yield on this stock, dividend per quarter is 61 cents, and the dividend per year is $2.44. I just take the quarterly dividend, I multiply by 4. If I take the $2.44, I divide by the price I paid, that $39 and change, I get a dividend yield, starting dividend yield of 6.13%. In a market overall that is very expensive right now, as an investor who is looking to drive immediate cash flow to pay my bills in the not so distant future, I'm really happy to secure a 6.13% dividend yield. And quite frankly, that is what my investing strategy is this year. It's about deploying money into stocks like BP. And so even though I paid a little bit higher than it's trading now, even though I paid a little bit higher than the recent low, I am more than happy to lock in that yield. And quite frankly, share price is irrelevant to me. All that I look at in the long run is my dividend cash flow. That's what I track. Now, I do track portfolio value, but it's more for just the purposes, quite frankly, of understanding in general, how is this strategy doing? How is it doing versus the benchmarks? Quite frankly, it's a byproduct of this YouTube channel because so many people are interested in how I'm doing as compared to the index. But if I were kind of just left on my own, I don't know if I'd even track my aggregate portfolio value that closely at all. It would be more dividends, dividend cash flow. And so for me, to lock in that 6+% starting yield, that's what I look at. That's the beauty of dividend investing, quite frankly. It takes the noise out of the game. It takes the share volatility. I just don't care. All I care is about seeing those dollars come through. So I want to look at a little bit of math, though, here to dig into this point just a little bit further, to dig into this issue of basically the types of comments I was receiving. There were certain people saying, Ian, you paid for this 8% run up. I paid 7.7% higher than the recent low. And so they're saying, Ian, you paid for this run up. And other people the next day are like, I got it cheaper than Ian by several percent. I don't really mind, again, about the share price volatility, and I want to illustrate that through math right now. So I'm going to share some more stats on the screen. Let's just look hypothetically. Let's say I invested $2,000. This is, probably more than a lot of people average in on a purchase by purchase basis. So I wanted to use a number that I thought was realistic, if not a little bit high, to illustrate the point. And let's just see, $2,000. How much am I down already? Hypothetically, if I invested $2,000 and I bought at the price I did, which was at $39.78, and we're down 2.4% already. How much money did I lose? I lost basically $47.76. So because I'm talking about on paper capital appreciation, bought the stock up here, it's down here, lost almost $50. And so the point I'm trying to illustrate again is there's so much chatter in the community right now, so much chatter. Oh my goodness, I'm scared to invest, or Ian, I can't believe you bought that high, it's already down. This is, remember, one of many tranches that I purchased. I've bought many tranches of BP. We'll get to that in a minute. And this is one of the higher tranches. But even looking at this, say hypothetically I put $2,000 into it, I am only down, quote unquote, $50. And so my takeaway here for the community is don't stress the small stuff. In my opinion, stressing this kind of stuff, we're not talking about tremendous amounts of money here. And I overpaid. Let's say hypothetically now I invested the $2,000. I bought it at the high, $39.78. But I could have bought it lower. I paid this 8% run up. If I had bought 7.7% lower, hypothetically, I've overpaid by about $153.76. Again, nothing that earth-shattering when you kind of analyze, hey, the tranche, the amount of money here being deployed hypothetically is $2,000. Yeah, I could have saved $150 some odd dollars if I bought lower. And because I bought high and it's already trended down a few percent, I'm down hypothetically here $50. But what I'm hopefully illustrating here through these numbers, we're not talking thousands of dollars here. We're not even talking like multi-hundreds of dollars. We're talking $50 in one scenario, $150 in the other, depending at how you look at it. In my opinion, in the long run, this is just insignificant. It's insignificant when I am here as a dividend investor looking to invest for the long run to drive cash flow that can pay bills. If my capital appreciation is down $50 or $150, I just don't care. And I think investors in the community, they're getting caught up in the volatility. They're getting caught up, quite frankly, in the mentality of more of a growth or total returns investor. And that is okay. Many of the people watching, dividend investing may not be for you, but I just want to illustrate this point once again, that for me, I just don't look at this stuff. When I buy a stock, I look at how much cash flow it added to my portfolio, case closed, move on. next week or next few weeks, buy more, deploy more money, always be deploying. Focus on the goal, which is the rising stream of cash flow, not these little volatilities. Did I make money? Did I lose money? Doesn't matter because I buy and hold forever. By context, let me just illustrate this another way. In the month of December, this is more than I would have liked to do, but I was doing a budget analysis. I spent $400 at Starbucks. Well, my family and I, buying coffees there, buying snacks, buying lunches. We spent a little bit more probably than we should have, but look at it that way. I spent $400 at Starbucks in December. Am I going to sweat the fact that I'm down $50 right now on this recent tranche, or that I could have bought $150 lower? No, and that's just another way to rationalize it, that I did a video early 2018. A lot of people are scared to start investing. They're scared because the market was at all-time highs. They're worried that there's going to be a major correction. And so at the point, the strategy that I conveyed to the community is, look, there is going to be some volatility ahead. There may be a crash, but the way that I handle it is I dollar cost average in incrementally. And I'm starting to see that concern in the community again. I think the reason people are so caught up in share prices and it's up or it's down or I got it lower than you, you paid more than I did, this and that, is because I think it comes from this place of concern, of fear over where we're at in the market. And again, my strategy for all this is to average in over time. And so I actually want to share some stats with you on that on the screen in a minute. In fact, I'll probably do that right now. My lowest BP purchase price was $28.77. My yield on cost on that, not including reinvested dividends, is an 8.48%. And so that's my lowest tranche. That was during the oil crisis a few years ago when the price of oil had plummeted. I bought it at $28. It's now at $39, or at least my most recent tranche was at $39. The highest purchase price that I paid for BP was $42 and change, 42.64. My yield on cost, simple yield on cost, not including reinvested dividends on that tranche, is 5.72%. So I bought BP for an 8.48% yield on cost. I've bought it for a 5.72, and I just bought it for a 6.13. I'm comfortable buying in this entire range, anywhere between 28 and 42, say, plus or minus a few dollars. Maybe I'd go higher than 42. I like it. I like it in that range. I'm willing to buy more, and I'll continue to average in. Do I sweat it whether I bought here, in the high 20s or here in the high 30s? Not really. It's fine for me in the entire range. And so this is a philosophy that has been game changing for me. When I find a stock I like, I find a value that I like, I find a range that I like, I don't sweat the day-to-day volatility. I have money to deploy. I just deploy it. That's how I do it. I'm not saying it's for everyone, but I'm sharing my personal journey here on YouTube. I want to look at this another way through dividend income. Check this out. So let's say hypothetically, I bought BP at the recent low. Let's say I bought it at $36.94. Instead, by the way, I bought it at $39.78. But let's say I bought it at the recent low. Okay. Instead of that, instead of my 6.13% dividend yield, I would be yielding 6.61. Okay, what would be the dividend income on a 6.61% yield on the hypothetical $2,000 deployed? It would be $132.11 per year. By the way, the yield I'm getting hypothetically on the 2,000 is 122.67. Okay, basically what happens is I take the 132 and change, I subtract the 122 and change, I would be yielding $9.50 more per year if I had bought it at the recent low. Again, I think people are sweating the small numbers. They're just sweating the small stuff. I would be earning, hypothetically, on this tranche $10 more a year in dividend income if I bought it at the recent low versus when I bought it now. To me, those type of discrepancies are irrelevant. For me, it is more important just to get money in the market, get it working, get it compounding, because as we know, as I've shared here so many times on this channel, the reward for dividend investors, it's long in the future. It's long in the future. There's been a lot of studies. If you look at Warren Buffett's historical net worth, in the early days, early decades, it was good, but it was nothing like it is now. It's only really within the last, say, 10 or 20 years that it's hockey sticked, and that's the miracle of compound growth, compound interest. It compounds the most in the latter years. And so in my opinion, whether I buy BP at $28, I buy it at $39, I buy it at $36, hey, I'm buying the whole range because I know 50 years from now, it's going to be higher, the dividend's going to be higher, and that compounding will have worked in my benefit. And so the earlier I can get my money working, the better. And quite frankly, even a few years from now, I'm going to be tapping into more and more dividend income. I already am tapping into some of it to pay some of my bills. I just need the cash flow now. And so I'm willing to buy it as long as it's in my range. I feel it's a fair value, and I think it is. And so I wanted to impart that wisdom. Now, I want to impart some other wisdom that's kind of related. This is really a mistake I think people are making because I see it on my Facebook group. And by the way, I don't want to criticize anyone because what I love the most about this community is everyone is coming with different points of view, different ways of doing things. And I'm a pure dividend investor. I think I'm a rarity. There's not a lot of people that literally when I buy a stock like BP, in my mind, I paid the 39 and change. I just assume all the money I put in is gone. Because I'm never going to sell. It's just a sunk cost to me. It's gone, never to be recovered. That's how I look at it. I look at it as if I were investing in a privately held company that had no liquidity. I'm buying it, never selling it. And so for me, all I look at is the stream of cash flow. That's it. And that's how I can sleep at night. It creates peace and harmony in my life. I love it. Many people, though, don't look at it that way, and that's okay. There's different strategies, but I see on my Facebook group, which is a group for dividend investors, I'll link to it in the description below if you want to join. There are a lot of people in there literally that are talking about very specifically, I bought it this many percent lower than it was yesterday, this and that, and timing the market kind of stuff. And all I'm saying is maybe that works for certain people. But when you look at the math, for most people who are deploying tranches of, say, $2,000 or less, the numbers are not very meaningful on these day-to-day swings or even week-to-week swings. Even swings up to 7 or 8% in the case of BP. It's up 7.7% from the low. The swing is irrelevant. It's absolutely irrelevant on a $2,000 tranche, in my humble opinion. And I want to speak next to why, one, that scares people out of the market. I'm going to share a comment with you about that in a minute. But before that, again, why waste your valuable time on that? That's how I look at it. My time is so limited. And so I'm very protective of my time. And with my time, I could spend time basically nitpicking day-to-day volatility in the market. I don't do it because, like I just saw, maybe I would have waited another day or two, I would have saved $50. However, I want to pop something on the screen right now. I'm going through my kind of audit of my finances because it's a new year. I'm closing my books out for the last year. I'm getting ready for the tax season. And so I was looking at some of my expenses, my expense reports, my business and employment related expenses. And what was fun in this whole analysis that I've been doing is I uncovered a bunch of costs. And I uncovered costs basically that is stuff that I should have filed an expense report for, but I didn't. And I actually uncovered a cost where it was related to travel. It was something that one of my business partners, a vendor of ours, a partner of ours, should have paid for the hotel, but somehow it ended up on my credit card because the hotel made a mix-up. And so instead of nitpicking the market to save, say, $50 or even $150 if I bought at the recent low, I was nitpicking my finances because I'm getting everything ready for tax season. I'm getting all my books ready and everything. And in doing that, check this out. I was able basically to find a $379 hotel bill that I was successfully able to get that charge reversed, and it was picked up by our vendor, by our business partner. I was able to pick up, basically I have a SaaS software I use for business, and I usually expense this stuff month to month, but part of the expense, it was actually getting taken, it was showing up in a different way. It wasn't showing up on my credit card bill in a normal way, and so I inadvertently did not expense it. Well, now I caught it, and so I'm able to expense $540 worth of SaaS software that should have otherwise been expensed. But maybe I would have missed this if I wasn't spending my time nitpicking my books. Something else, I was at Office Depot buying some business related supplies. I forgot to expense it. It was $146 and change. By nitpicking this stuff and spending time uncovering money versus nitpicking my purchase price on BP, I basically just in, say, a few hours of time was able to uncover $1,065.61. And so you contrast that, you start looking at your own time. There's only so many hours in the day. And yeah, I'm not going to uncover $1,000 every month just like that. This is kind of a yearly thing when I'm going through the books. But if I didn't take the time to go into my books, which maybe I wouldn't have had that time if I were trying to buy BP at the low or time the news of this and that and buy it at the right point. No, if I were doing that, I wouldn't have the time. And so my time is limited. Instead, I chose to focus my time on something else, which I view as being more productive. I made $1,000 that I can use to buy more shares of BP or whatever. And maybe I left $50. Maybe I even left $150 on the table. That's why I do it. That's the way I approach things. And so I want to move on to a question now. This is something that came up on the Facebook group. And it was a subscriber. I did not write down your name. I apologize, but he was asking a question. It was about Boeing. Boeing, I'll just tell you off the bat, this stock is not for me. I won't be buying Boeing. I don't want to buy Boeing. I did a video on this a while ago. But I do wish anyone who is in Boeing all the success in the world. And it is a really cool company, one that I've thought of buying over the years, but it's just not in the cards for me. But I wish you the best. But anyways, he was asking about Boeing. I want to put this on the screen. I want to put this question on the screen because it's very relevant to the topic I am discussing right now. And don't worry, I will get to my PPL purchase a little bit later as well. So let's check out Boeing. So the question goes like this. I have about $1,000 in Boeing. I'm about 5% down. My total portfolio is about $26,000. Should I dump them and move somewhere for faster growth and returns? Thanks, fellow investors. So this is a question, again, this is from a dividend investor. This is not a question in some stock trading forum. This is a question in the dividend investing Facebook group that I manage. And so if you want to join the group, by the way, again, in the description, check it out. We have an awesome group. Anyways, this question comes up and I got to thinking. I'm like, hey, I have an idea of how I would answer this fellow's question, but instead of doing that, let's do some math. And so I want to share some calculations on the screen with you around Boeing. So check this out. He said, I invested $1,000. He said he was down about 5%. Okay, how much is 5% of $1,000? It's $50. So this investor is down $50 on Boeing. He says his portfolio is worth about $26,000. Okay, how much is Boeing as a percent of the total? If I take $1,000, I divide it by 26,000, Boeing represents about 3.85% of his portfolio. Now we know he's down $50. Okay, what is $50 as a percentage of 26,000? It's 0.19%. So this investor is down 0.19%. And he's wondering, should I move my money out of Boeing for faster growth? I'm not trying to make anyone look bad or feel bad. I want to point this out because I think sometimes investors get caught up in the emotional side of things. I think sometimes investors get caught up in the news. They get caught up in all the scare tactics of the media and all the bad news out there about Boeing. Obviously, my heart goes out to any family affected by anything related to the Boeing aircraft that are not performing allegedly as they should. I don't know what's happening with these aircraft, who is at fault, who is not, but certainly my heart goes out to anyone involved in these kind of horrific situations. But basically, my belief of what's happening here is people are seeing the news, and this investor literally, he's down $50, but he's wondering, should I sell Boeing because my entire portfolio is down $50 or 0.19%? I don't even think I have to answer the question at this point when you look at the math. I think a lot of investors, they're not looking at the simple math. They're making that mistake. And when you look at the simple math, I think it helps illustrate what you're going to do. When I would look at something like this in my own portfolio, hypothetically, if I were down $50, like I said, I spent $400 at Starbucks in December. If I lose $50, it's like a dinner. It's a dinner out with the family. That's a frugal dinner out with the family. Providing for myself, my wife, 2 kids, buying 4 meals, $50, probably can't even get that done that easily. Maybe at more fast food type place, but at like a nicer sit down restaurant, probably looking more like $60, some odd with tip and everything. And so all I'm saying is, would I be sweating something like this? Like, I don't own Boeing. I don't plan to own Boeing, but let's say one of my stocks, BP, for example, I'm down 50 on BP. Am I sweating it? No. In the scheme of things, you look at the raw numbers, you just start seeing that this is kind of insignificant. But let's look at this another way. I want to look at this another way. This investor is concerned about the future. This investor is concerned Boeing is not going anywhere for a while. Let's just say a hypothetical. Let's say Boeing goes nowhere. But let's say instead this investor could take his money out of Boeing and put it in another stock that doubles. Okay, well, the value invested would be 1,000 because we know he has 1,000 in Boeing. That 1,000, the new value is 2,000. It's up 100%. The old portfolio, let's say it just went up, it doubled overnight. Overnight, literally, got lucky, bought something good. Let's say it was BP, doubled overnight. Okay, portfolios were 27,000. How much did the portfolio go up? Well, 27,000 minus 26,000, obviously $1,000. $1,000 divided by 26,000 is 3.85%. So what I'm trying to illustrate here is even if this investor got out of Boeing's not doing well, it's going nowhere, got the money into something else that doubled overnight, the best this investor could do would be 3.85% return. What I'm trying to say is when you have a diversified portfolio, any one position, even if it doubles, it really doesn't matter that much. And so, look, I have one of the most diversified portfolios out there. I have almost 44 positions. I have 43 now. I'll be buying another soon. But any one position in my portfolio just doesn't matter that much. It's insignificant on the upside, but also on the downside. And that's why I diversify. Diversify for stability because I'm building a portfolio that will be robust and can live on for generations into the future and provide stable cash flow. And so I like the diversification. But what helps you on the diversification on the downside, it also hurts you on the upside. And so even here, if this investor got rid of Boeing, doubled his money overnight, the best he could do is a 3.85% increase in portfolio value. And so you start looking at it that way and you start thinking, okay, is it really even worth the time? It's not. And so the way I look at it is it would be better to take this time fretting over these specific things to literally go do the type of work I'm doing. Look at your books. Can you come up with $1,000 of expenses you forgot to submit in your expense report? Can you, instead of going to Starbucks, start embarking on a journey like I am to drink coffee at home? I've been drinking the Blue Bottle cold brew coffee at home. It is delicious. What I've been brewing up at home with the Blue Bottle and the creamer from Coffee Mate, man, it tastes almost better than Starbucks. I love it. And so I'm actually prepping for Frugal February. This is something that fellow YouTuber Canna Campbell, Sugar Mama TV, I think she invented this. She does it each year. It's called Frugal February. It's a financial detox. It happens in February. And my wife and I have been talking about this. We want to, for our family, do a Frugal February this year. And I haven't set my goals yet for Frugal February, but I may do kind of a goal of Starbucks. Like, I can't say no Starbucks because I do meetups there and such. And we have a meetup coming up, by the way, next week. But maybe I'll say once or twice out of the whole month. I want to make things a little more difficult on myself. I want to challenge myself. I want to make myself uncomfortable. I want to make myself a little bit unhappy, quite frankly. And so I might be doing the home brewed coffee most of February. Maybe I'll treat myself a few times. No more than 4, that's for sure. And so anyways, though, should I be focused on Frugal February where I could probably save a lot of money, or be fretting over this kind of stuff? And I think the answer is obvious. I don't even have to answer the subscriber question. And so if the only caveat I would say here is if this investor is questioning Boeing because he didn't do the research getting into Boeing, and now that things are coming to fruition, he's getting kind of weak hands on Boeing because he feels like he didn't do his analysis. That's different. Hey, I've been there, done that. I owned a stock, BHP Billiton. I got out of it for that very reason. It was one of my financial mistakes I've discussed on this channel before. I owned BBL. It started doing bad. I got weak hands. I dropped it because I realized, Ian, I never bought this for my own reasons. I bought it because other people said to buy it. hey, got out of it, lesson learned. And so that's the only caveat where I would consider selling something, is if I didn't feel authentic about it. But let's saying this investor did his research, he likes Boeing, he feels good about it, down $50, thinking could the money be doing better elsewhere. You guys know my answer. If you're a true dividend investor and you're in it for the cash flow, some of these fluctuations, these what have, would have, could have, should have, if that, if this, it doesn't matter. It really, really, really doesn't matter. And the time is better placed generating money, uncovering money, manifesting money, saving money, and just getting the money, getting it into the market. And so that's what I do. Again, I can only comment to my personal situation, but that is how I approach it. And so let's look, though, one more scenario here while we're on the topic of Boeing. Doubling 100% overnight, that's not very realistic. That was a corner case. Let's look at something more realistic. This investor gets rid of his Boeing, he puts it in something else, and it goes up, the thing he put it in goes up 25% overnight. How much impact does that have on his net worth? The portfolio, in that case, would only be up 0.96%, so just under 1%. So for all this time, all this effort, up 250 or just under 1%, is it worth the time, or would it be easier to go generate the 250, or quite frankly, who cares about the 250? Go do something fun with life. Go running, go swimming, go to a movie, go whatever. Go do woodworking or projects like around the house. Sleep a little bit longer. What is that 250 worth to you? What is your time worth to you? And so again, I think these concepts will be more meaningful as well to investors on the channel who have bigger portfolios, but even to investors starting. Sooner or later, this is a community of winners. This is a community of successful investors. At a certain point, these concepts will make very big sense to everyone watching. And so I think these are just fundamental things to the way I do things that is just so different to the folks out there getting scared over these minor fluctuations in the market. And I don't want to talk down to, I'm not trying to say to people, oh, if you think $50 is a lot of money, you know, that's not right, or something like that. To me, $50 is a lot of money. I cringe when I lose money or when I waste money. I understand that point of view, and I'm not trying to put down people, absolutely not, who may look at certain amounts of money different than me. It's more that I'm trying to say your time is more valuable than you think. You can do more with your time than you think. The best results in dividend investing come over the long run. That's when the compound interest kicks in, and life is short, and you ought to be very careful about this stuff. And quite frankly, you also ought to be very careful about getting completely scared out of the stock market because of this type of volatility, because that is what I'm seeing a lot of people facing right now. This is why I love dollar cost averaging so very much. So I want to jump into something else now. I want to talk about my PPL purchase, because this, like my BP purchase, some people were asking, hey, Ian, it's up a lot. Why are you still buying it? And so let's look at some numbers as it pertains to my PPL purchase. All right. So I bought PPL recently. This week, $35.57. The dividend per year is $1.65, and so my starting yield is a 4.63. I love that. The analyst estimate for this year, last year, 2019, is 243. For this year, 2020, it's 253. So that PE is in that nice 14 range. Getting a little higher, kind of at the borderline of where I want to buy PPL, but it's still all right. All right, my lowest price per share was back in that $29 range. I'm up 21% since I started buying PPL. I'll link in the description below to the video I did when I initiated my position in PPL. And let's just look at this. Hypothetically, let's say my first tranche was $2,000. If it was, I would hypothetically be up $425 on that tranche. And again, my dividend yield, starting yield on my first tranche was a 5.62. Hypothetical dividend dollars on that first tranche, $112 and change. And so, yeah, this one's harder to look at, quite frankly, than BP, because $425 gain on my first tranche, that's pretty good, especially that it's only been a number of months. But again, when I buy dividend stocks, those gains, capital appreciation, it doesn't matter. Why? As I look at the purchase as a sunk cost, that money is gone forever. I will never sell, so that money is worthless to me now, in theory. Obviously, it's nice to have the portfolio value because if I ever needed the money in an emergency, thankfully the stock market is liquid and I could sell. But the way I look at it in my mind, to trick myself, if you will, is I consider myself buying a private business that's illiquid. I'm only buying for cash flow. If I look at it that way, let's not look at the 425. Let's just look at cash flow. On my first tranche, if I had deployed $2,000 hypothetically, I would be yielding $112 per year in dividends. On my most recent tranche, hypothetically, if I deployed $2,000 again, I would be yielding $92 a year. Now, there's a $19.71 delta between the two tranches in terms of cash flow if I deployed the same amount of money both tranche. But in the scheme of things, $92 a year in cash flow in this market on a stable company that is facing a little less risk than it was a few months ago when I first bought it, that's not bad. Yeah, the $112 cash flow a year is better, but the way I look at it again, I am buying cash flow. That's all I'm doing. Any given time in the market, I'm taking my money, I'm evaluating the universe of opportunities, I'm deploying the money, and I'm buying cash flow. It so happens that right now I'm buying current cash flow that I can use right now. A lot of the time, I'm also buying future cash flow. I'm buying low yielders that have high dividend growth. I'm buying future cash flow. And so that's all I'm doing, though. I'm buying cash flow. And when you start looking at it that way, you don't get as scared. When you start looking at it that way, you don't waste your time on the day-to-day volatility and all the news, this and that. When you look at it that way, you sleep better at night. You have more fun in life. You can do other things in life that are more rewarding than nitpicking news day to day. I have learned this the hard way, let me tell you. I used to be a different investor. I've been in this for over 20 years. I've tried it all. I have, in my early days, done stuff as crazy as day trading penny stocks. And so let me tell you, I have done it all, been there, done that. This is after decades of investing and learning things the hard way that I am sharing these insights of how my journey has evolved and how I've developed a system that it works for me at least. It works really, really well. And so I want to move on now. I want to share a few more things. I want to share some bonus material, actually. So we are on the topic right now of goals. This is an interesting one. So I announced in a recent video I was going to buy Wells Fargo. I'll link to it in the description below. And some subscribers called me on it. They called the BS. They said, Ian, you just shared your 2020 goals with us. And you said if you were going to buy a net new stock, you were going to sell one first. This really triggered my thought process, because it's so funny. When I decided to buy Wells Fargo, I wasn't thinking about those goals. I had forgotten the goals. And I started reflecting, Ian, why are you doing this? Why are you breaking your goals like 1 week after setting your goals? And then I started realizing, Ian, your goals are a bunch of BS. Just like the subscribers are calling BS on you breaking your goals, the very goals themselves are no good. They're bad goals. And so what I realized is, for a lot of my life, especially in the last, say, 10 years, I set these annual goals. They're kind of micro level, very specific, and I would live by those goals. But this year, a lot of you know I'm kind of getting more into spirituality, getting just more into deep thought, and I'm starting to challenge myself a little bit more to enjoy life, because I made a lot of sacrifice, quite frankly, in my life thus far, against enjoying things to benefit the money and to benefit the future. I'm kind of at a point now where I want to live my best life every darn day, and I want to enjoy every day. I want to be happy every day. And so I started thinking, are the goals that got me to where I am serving me anymore? And I basically realized, no, they're not. And quite frankly, are these goals making me happy? No, quite the opposite. They're making me upset. They're not good goals. And then I start thinking, why did I do these goals? And then I'm like, quite frankly, I did the goals because I felt like I had to, because I had to have a content for the video. I've always done it that way in the past. It's how it's always been. So I did the goals, but are these the right goals for me? Or are they the right goals for YouTube? And so I started thinking more. I'm like, you know what? Get rid of it. F it. I'm not doing those goals. And so I decided I'm going to have two goals this year. I'm going to have two goals. I'm going to have one goal, most important, is I want to strive each and every day to be happy. Consciously, I want to focus, Ian, what can I do today to be happy? And if there's anything happening out there that is not making me happy, how can I resolve it? How can I move on? How can I minimize it? I want to live my best life every day. So that's goal 1. Goal 2, as I announced on Twitter the other day, is I want to write my book. I'm doing it. Thank you everyone for your feedback. I've decided to do it. I'm writing my book by the end of the year. I will be done at least with the first draft of the book. I'm sure there will be more editing and such that goes into the next year. It won't be published this year, but I'm going to write it. I'm going to write the whole thing this year. And so I started thinking, will those goals make me happy? Yes, they will. And why will they make me happy? At the point I'm at in my life, the same stuff that got me to where I am, it's not going to work anymore. I've lately kind of felt, quite frankly, like I'm in a bit of a rut. It's getting boring. It's getting too mundane. And I'm like, how can I turn things upside down enough to make it interesting? And that's quite frankly why I decided to do the book. I'm doing the book because it's going to be hard. It's going to stretch me. I want to do it. It's something that is a lifelong aspiration. I don't even care about the money, quite frankly, from the book at this point. I just want to do the book to be able to do the book. It's for the passion. It's for the culture, if you will. And so then I realized, first goal, I'm so good at the other stuff now, working out, staying in shape, deploying money in the stock market, keeping my portfolio well managed, doing the family stuff, this and that. All of those other little niche goals, I don't need to spell them out. They're just going to clutter my kind of day-to-day record keeping. I don't want to have to think, did I do this goal? Did I not do this goal? This and that. I know if I strive to be happy every day, everything else is going to flow. The spirituality, the investing, the family, the fitness, it will all flow down. And so anyways, that's how I've evolved here. I'm buying 44 stocks. The reason I'm not following my goal is literally I thought about it more and I don't like my goals and my goals aren't making me happy. And I kind of did my goals because that's how I've always done my goals. And at the time I had the right reasons for those goals, and most of those goals will still stand. Quite frankly, even the 43 stock goal will kind of stand in a way. When United Technologies, for example, splits up into several companies, 3 companies, I'll probably only keep one of them. When Pfizer splits into 2 companies, I'll probably only keep one of them. So with a lot of these split ups that are happening, because I'm going to be buying Wells Fargo, I'm going to be a lot more focused on keeping the house tidy and clean with these split ups. And so that's something that will kind of make that goal relevant in my mind. And all the other goals I had, I don't need to track them day to day. They're just going to flow out of the happiness. That's how I'm looking at it now. And so I'm not saying this is the right goal setting methodology for everyone out there. I'm saying it's the evolution for me. I've done the other way of it for enough. I've grinded it out long enough. I'm at the point in my life where I got to do what makes me happy, and that's how I'm doing it. I also want to point out today some more bonus content. In my last video about Wells Fargo, I asked the community for feedback. I got great feedback. I got excellent feedback. And some of the feedback actually inspired me to write a blog post. So I will link to that in the description below and also in a pinned comment. Check it out. But I received some feedback on how goodwill works. That feedback caused me to investigate goodwill, to research actually intangible assets a little bit more, and to investigate some other concepts such as the Tier 1 capital ratio. And so basically, I don't want to rehash my blog post here, just read it, but I'll do real quick. The way goodwill works is basically if a company acquires another company and they pay over the book value, assets minus liabilities, they pay more than that, they pay over the book value. The difference of assets minus liabilities, the purchase price minus that, is carried as the goodwill on a company's balance sheet. I've always disregarded goodwill, and I still do in my financial analysis, because the way I look at balance sheets is I look at it typically in a worst case. If the company is going bankrupt, what can they get? And I don't look at goodwill as really worth too much, and I still don't. But I used to think that a company itself could orchestrate a higher goodwill. There was a mechanism for a company to add their own trademarks to goodwill. There was a mechanism for a company to add value to their own brand name to goodwill. No, my understanding at this point is goodwill is only when a company acquires another, and the difference between what they pay and the book value gets carried as goodwill. And I started thinking intangible assets as well. It was always my belief that a company could inflate its intangible assets by adding value for its own trademarks, for its own brand name, for its customer base, this and that. My understanding at this point is there's no mechanism for a company to value its own patents and trademarks unless it purchases them. The only way from a GAAP financial basis that value could be attributed towards trademarks and towards patents is if a company buys them. Because if a company doesn't buy them, it's hard to dictate a market value of such assets. And so therefore, those are typically not carried on the books as intangible assets. A lot more about that in my blog post. I want to thank the community for the feedback. It doesn't change my philosophy. I still just completely disregard goodwill and intangibles, but it gives me more understanding of how they work on a very technical basis, and it gives me more appreciation that a specific company cannot inflate the goodwill or the intangibles, except if they're way overpaying for an acquisition, either of a company or an acquisition of certain assets, because a company sometimes can buy trademarks from someone else. If they do that, then those will get placed typically as an intangible asset on the books for the price they paid. And so just gives me a little more technical understanding. And the main takeaway from all of this is, as a community, we are almost 50,000 strong. We are strong. There are subject matter experts in this community in pretty much every niche, every industry there is. And so my belief is that we have all the answers we need here as part of a community. And I love that. I love, as an investor 20 plus years into this, I'm still learning every day. I love it that the community is sharing the knowledge with me so I can be a better investor. And that's what it is all about. That's what our meetups are about. That's what the Facebook group is about. That's what the comments are about in the comment section below. Thank you if you participate in this community. You are awesome. I love you all. And so check out the blog post. There's some more stuff in there about tier 1 capital ratio as well as it pertains to bank stock analysis. I thought that was a good ratio to do for leverage. I'll give you a quick heads up that Wells Fargo still came out on top. It was the second best, just under JP Morgan Chase. And so I was happy to see that on the tier 1 capital ratio, which is a metric of leverage. It is basically the shareholders' equity divided by risk-adjusted assets. That gives you the tier 1 capital ratio. The banking standards have it that ratio has to be 6% or higher. All of the contenders I analyzed were way higher. Wells Fargo was the second best, although Wells Fargo did see a tier 1 capital ratio drop year over year, comparing 2018 annual report to 2017. So it's something I will have to keep an eye on for sure. Love it. Love learning. All right, everyone. If you enjoyed the video, please give a like, thumbs up, subscription, comment. All of it means the world to me. Check me out on Instagram, Twitter, just sharing all my trades there. I love you all. Happy 2020. I wish you a fabulous year. Share your goals below. Share them in the comments section below. Before I leave today, in terms of a full disclosure, I am long the stocks mentioned today. I am long. I own BP, ticker symbol BP. I own PPL Corporation, ticker symbol PPL. I am long Starbucks, ticker symbol SBUX. Wells Fargo, I'm going to be buying in the next few weeks, ticker symbol WFC. And I'm long United Technologies, UTX. I am long all of those stocks. Oh, and Pfizer, ticker symbol PFE. I own that stock as well. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my personal journey here on YouTube for fun and entertainment. I love you all. Happy investing. I will see you in the next dividend investing video.